Fathom that. The S&P makes new all-time highs. I'm sitting at home thinking, how can I give you a good presentation how institutions love to hedge their huge positions? And then President Trump comes out and says something about China, and the market takes a 2% dive. We'll see whether there was something or nothing, but if you're interested in finding out how institutions hedge, stay tuned. Welcome, fellow investors, speculators, and traders. In this presentation, I want to give you an overview how institutions who run huge portfolios, who mostly assemble the S&P 500, let's not start kidding about it, how they like to hedge their positions. I've traded that over my career over and over again, so I was on the other side of the hedge transactions clients are executing in markets, and that has implications. As you've seen maybe in other videos of mine, one guy, in this case the client, has an idea what he wants to do, and the market maker has to facilitate this idea. They do their transactions differently, especially when these transactions are live and in the market running. So I thought I'll give you a run through how they are actually doing what they're doing, they being the institutional clients out here, and what implications does that have on market dynamics, because the guys who are hedging their positions, the market makers and the dealers, have, well, a different approach to these positions in the market. So I've called this all-time highs. Who's hedging what? The market mechanics influence on market behavior and volatility, but I might as well have called it the price of having a good night's sleep, effects on the option buyers and sellers. As always, quick run through. Who am I? Thorsten Roland Wegener. I used to be a market maker. I was a partner at Bear Stearns, responsible for the equity derivatives, for the structured business in Germany, Austria, every country that's speaking German or is able to speak Germany. And now I am a lecturer, advisor, author, house husband, and apparently a YouTuber. One day I'm going to make a video where I introduce myself. So that's it. Let's start. All-time highs. Who's hedging what? I take an example, the SPDR, because, well, each of you might have traded the SPDR already. If you have bigger accounts, you're on the road anyway in S&P futures or the SPX options, XSP, the smaller ones. Doesn't really matter. I'm choosing the SPDR ETF right here, and for this example I said, okay, let's assume we have a portfolio of individual stocks which assembles as if I would have bought 100 SPDRs. To make this a little bit easier for you, I haven't taken the current price of the SPDR. I started with, let's assume the market is now exactly at 100. That makes it easier running with percentages and everything. But I've taken the original data from the SPDR: volatility, skew, maturity, interest rates, and dividend projections to make that as realistic as possible. So let's start. You own 100 SPY shares. That is $10,000 at the price of 100 at the moment. So what are you going to do if you want to hedge it? Well, the easiest way, you buy a put option. And in this case, I've bought a 95 strike put option, which would cost me 157 US dollars. So why not directly at the money? Simple reason, it's too expensive. It costs you a lot of money, and you say, yeah, fine, markets fluctuate, plus minus 5%. Should in normal markets actually not be a big issue if I have the trend correctly. I'm willing to suffer the first 5% in losses, and then obviously I want to have downside protection. And the case we have here, by purchasing the 95 put option, I have something which turns out to be, oh, it looks like a long call actually. Well, it's simply the dynamic of option strategies. How's that? You own the shares. If the market goes up, you make infinite amount of money. If the market goes down, you have protection at the 95 level, so you can never lose more besides the premium you've invested. If you buy something where you can only lose the premium you have invested, but you have an unlimited upside potential, what is that? Well, it's a call option, right? So, and I've priced that time frame 90 days because that is what you see very often in the market. Why is that? Well, quarterly. Yeah? Each quarter they look into their portfolios. Management is being rated. How have they done? So a quarterly protection makes sense. And in this case, you would pay 157 US dollars, and that is a 1.57% debit cost for your insurance you have in there. If the S&P in the long run makes 7% over the last 20 years, makes 10%, 1.57% insurance for 90 days is rather a lot of money. So is there a way of getting away with paying less? Of course there is. You do the following. You start selling a put option at 90. Why would I do that? So from 95, I start making money to the downside. I'm being protected. And at a put level of 90, I suddenly start losing money again. It would look like this. Well, you build in a little step, because what is it all about in this market for institutional money? How you're being measured, and we're getting even into game theory. You've heard about prospect theory, Kahneman and Tversky. Kahneman got the Nobel Prize for it. Tversky didn't. He was already he had departed 2 or 3 years earlier, so they're not handing that out posthumous. But losses are being treated in our brains far more severely than winners, right? And the gray line is your S&P line you would have had. So if you're a portfolio manager and you know the guys who are judging you, the guys who give you their money to manage for them, do not want to have the same profit or loss profile like the SPY. Well, why would they? Otherwise, they could simply buy their Delta 1 products, which is now 50% of the market apparently doing, and it will end in tears, but that's time for another video. So they start spending some money, in this case 0.68% for 90 days, and build in that little step, which means the market falls by 5%, then your protection kicks in, and then the market falls another 5%, goes down to 90, and then you start losing money again at the same rate as if you would have had the long equity position. But already look at what the market is doing. It's following the gray line, up and down. And you have already taken away, as a portfolio manager, some of the pain. 5 points of agony you have not passed on to your customers, though they will look at the statement and say, okay, right, that sounds all right, I've given him my money and he's protected, he's better than the market. Okay, that's why they want to do that. And then we additionally add another short call, because we are still too greedy. We don't want to pay the 1.68% for 90 days of this kind of insurance policy we've created here. And how do I do that? Well, the market is trading at 100. I think there's another 5%, and don't nail me on the 5%. It could be higher, it could be lower, depending on the market view of the investor. And again, coming out of prospect theory, at least my take, say, okay, fine, I sell a call and I receive an additional premium. This call is 5% above the current level for the 90 days. What does that mean? If the market goes to 104, well, I've made my 4. Nobody's going to exercise the call, and all the put options in my portfolio are worthless anyway. Markets did what they wanted to, were supposed to do. They went up, and I'll end up here, like the market did as well. How does that structure look? When I add it all together, the blue line now, we still have our step here, which gives us a certain protection of these 5 points to the downside. And I cut off my profit at 105. For that, I receive a premium. This received premium, obviously, I have to build in my pricing. I sold a put, I bought a put, and now I sold a call again at 105. And suddenly, I don't have to pay a debit anymore. Now I receive a tiny credit of 0.38% for my 90% insurance portfolio that I built up here. For the simple idea, yes, market can move another 5% to the upside. When we expire at this level, I've made just as much as the market did. If the market moves up 10%, my clients will see still a 5% increase in their portfolio. So nobody's ever fired somebody on the, well, mundane investor side, the mutual fund investors, if their mutual fund made money, the market might have made 7% and they made 5%. Okay, fine. You probably say, "Oh, it could have been more, but I'm happy. I'm making money on the downside. Still works." You look at your statement and say, "Oh yeah, portfolio manager's done a good job. The market fell by 10%, and I only have a loss of 5% in here. Sounds fantastic to me. Okay, must be a good portfolio manager. Nobody ever got fired over a position that ended up like this." So, and because you got a credit, you also have a new break even. At the moment we were at 100, and now we are 99.62. That's exactly the 38 cents you got as an additional credit in. So market goes up, your break even is already in the money, you're going up, you're making your clients happy in this. So, and this is called a zero cost collar. There are bells and whistles, and you can set it up in different ways with different strikes and add on other parts with shorter dated options to get some additional premium, but that's just confusing. That's what the pros do to fine-tune it, to play a little bit around with it, get some additional pickup, it's called, in their positions. But the general structure is the zero cost collar. Why collar? Because it's like a collar you wrap around your neck. To the upside, you're giving upside potential away, and to the downside, when the icy breeze of a bear market comes in or a temporary setback, you're not suffering as much as the others. So you have a collar here as well. So the client delta. You've seen on this channel we're talking about delta as a measurement in probability. If you have a delta of 50, which means by the end of the expiration time, you will most likely be with a 50% probability above this level or below this level. And when you own shares, and we assume a bell curve, the next day is a 50-50 chance, and also not assuming any drift. In a year's time, it's 50-50 where you're above or below this level. By taking on this structure, owning the shares, owning the 100 spiders, selling a put, buying a put, and selling a call, like we've just done in our example, the delta position is not now 100 as the investor would have had before, but it's only 61, right? So if the market goes up 1 point, you make at the beginning, when the position is alive, which is represented through the really tiny blue line here, you make $61. When we go further up and further up and further up, you're cut off at the 105 level, and your delta is, you see that here in the decline, you're not generating any new shares. That's it. From this point, 105, you can't benefit anymore. You've given that away. When the market falls, you can see we're getting a bit flatter here through this period between 95 and 90, and then your negative delta starts growing again because, hey, you are not your negative delta, your positive delta. You're long the shares, and when the market falls, goes negative, you obviously lose money. On the upside, the negative delta is nipping away on your long position. On the downside, your long position is totally intact till you lose $1 for every dollar market goes down. So what have I got here? Now I've reduced the time frame to give you an explanation for what happens 5 days prior to this expiration is happening. You can see the pink line in here is what used to be the red line 90 days before that. Let's get into this. We see we're definitely steeper here. If we're still here at this level, suddenly my delta is almost as my original position of 100 spies used to be. It's 96 deltas. Why is that? If the market moves suddenly up very sharp, I'll make money till I reach the 105 level, and then every additional dollar gets eaten away because I'm getting short, and this short delta suddenly eats away everything above the 105 level. If I would now from the 100 level start falling very fast, that is in a way a good thing, because what happens to my delta? I had a very long delta here at almost 100, and now my long delta goes down, which means I'm still losing money. The market is falling, right? But I'm losing less money if I would have only hold the shares. And when we then reach this level, the 90 put, I'm short again. You see suddenly what happens to my delta? My delta gets long again. I'm up to 100, because from this level on, I start losing $1 for $1 again. That is the dynamic I have in this portfolio as an investor when it goes into expiration. So let's flip this sucker. Why? Because I wanted to demonstrate you the customer bought this for this specific purposes, to say, I'm not paying anything for this insurance on the downside, and I'm giving up a little bit of upside. Where does he do that? He does it, or she does it, at a market maker, asking them for a price. So this is my position now as a market maker in my book. I'm long a call, yeah, client sold that to me. I'm short the put, client bought that, and I'm long the 90 put because client wanted to raise more money and sold that to me. I had to buy it. So I have the mirror image. What do I not have? I don't have an equity position. Yeah? So my position looks pretty much like almost like the mirror image of what the client has in her portfolio. So, and now what do I do as a market maker? Of course, I hedge it. Yeah? Here's my position, and I have a delta in this position. Yeah? The same delta we spoke about the client at the moment. When the client just trades the options with me, I end up with being the equivalent of 38 deltas long in the SPY. What does that mean? Market goes up by $1, I make $38. Market goes down, I lose $38. As a market maker, I'm not in the business of taking any directional risk. Yeah? I want to hedge this directional risk away. What am I doing? I want to get rid of the delta I'm having here, 38 deltas. So what I'm going to do, that is now the gray line I've introduced here. Obviously, if I'm delta long and I just want to get rid of the delta, I have to sell some shares. We saw I had 38 equivalent deltas long, which is the equivalent of 38 SPY shares. So I'm going to sell 38 SPY shares right here. And now something fantastic happens, and you will think it's a bit weird, but have a look at this. My position, who used to look like this, now turns through the hedge transaction in something like this. Yeah? We have here the wobble with a 95 put I'm short, and the 90 put I'm long, and the 105 call I'm long again. You've seen these positions before. Yeah? This is, how would you call it, an abused long strangle I have on my book. Why do I call it abused long strangle? I make money on the upside and I make money on the downside on expiration. To achieve that, I'm paying something. What did the client do? The client ended up with a credit. Who financed that credit? It comes from the market maker. Yeah? For me, it's a debit. I've paid for this position to have this beneficial structure available after I do my hedge. And you see, I'm not doing it with 100 spider shares. Then I would just be the other side of the client. No, as a market maker, I go in and say, I only have to sell 38 shares, and my delta, then in this case, is right here. I will be at 0.1 delta. So I'm not interested, or I'm not bothered by a directional move to the upside or to the downside. I've put my hedge on, and now let's see what happens when volatility, for example, starts falling. When volatility starts falling, and I have the recommendations for my video on the VANA where I explain it in detail what happens. This delta line takes on a different shape. It gets steeper here and it gets steeper here depending on the position where we are. Why is that? The probability gets less that the market has more to stretch. Yeah? Volatility is falling. I'm here at 100. Okay, it gets smaller and smaller and smaller. My delta will at this point stay the same. Let's assume we are here, and you can also take the pink line as an idea. We are already here at, let's say, 112, and volatility starts falling. I'm long the 105 call here from that level. It's now more likely that the 105 call will be in the money, generate a profit. So it moves closer to this. This is again the expiration line 5 days before, because what I just told you for the VANA, when volatility is falling, is true for time decay. Yeah, and that's the charm. It's also a video on this channel, has the same effect. If I only have 5 days left and we are here at this level, well, what does that mean? It's very likely that the 105 call I own will be long. So what does that mean? My delta out of my option position gets bigger. I'm a certain amount of shares short against it. So my delta is higher. We used to be here, yeah. I was the same amount shares short as I had delta long through the options position. So this is now getting higher, my delta. What do I have to do to stay delta neutral? I have to sell some more shares. That means the market is losing implied volatility goes slowly up, and as a market maker, and that's in the other videos, I can provide liquidity for this market. Volatility will go even further down because suddenly my delta gets more long. The same is true for the charm, for the time decay. Time can only decay in one direction. Obviously, I can roll it, but for the purpose of I have this one position, it's having the same shape here. And let's take the other example as well. What if we started at 100 and market starts falling? Market starts falling, you must not forget, I'm short as a market maker, the 95 put, which is bad for me. I'm getting more long when the market is falling. And suddenly my neutral delta, where we started with 0.10, is getting long. Okay, what do I do when I'm too much long? Well, I have to sell some more shares. So what am I going to do? The market is falling and I have to sell shares, which means I take liquidity away from the market. There are other guys, maybe only a certain amount, who want to buy shares. And now I'm additionally there and filling it up. So I'm fueling this fire, but not for long, only till we see the 90 here. When we come into the 90, you see my long delta dramatically goes down again. Why? Because here at 90, I start getting short again. When the market falls per expiration, I will start making money. So you can see that where we are in this cycle, in the money far above or in the money far below, I will have, as a market maker, influence on what you can see hitting the screens. The client doesn't do anything most of the time. He just has this position on, he has the hedge. If market goes up by, let's say, exactly 5%, he's a hero. He had an additional pickup, he was protected to the downside. Great scenario. Markets fall, not so nice, but, well, he's better than the SPY, and he's better than his colleagues who didn't put up a zero-cost collar in that portfolio. We'll give him a slap on the shoulder. Yeah, we've lost money, but you've done well. You've got your stuff under control. And this is the dynamics we will see in markets. One guy, the institutional manager, doesn't need to do anything. If 3 months are over, he's going to roll the position again. And that is the interesting bit. I've almost forgot. Where is all this red shenanigans also coming from? It's the gamma position I have here. The dark orange line is the gamma position at the start, 90 days in. And what you can see is the more time decays, the closer we go to expiration, my gamma is getting bigger and bigger. In one case, I'm gamma long. In the other case, I'm gamma short. Gamma long is good if the market moves, and it's bad if the market doesn't move. And gamma short is good when the market is not moving at all, and it's very bad when the market is moving a lot. So you can see here the example we just had with our delta. When I'm running through the 95 put, I'm short. It's bad for me. I get more long. However, the closer we get to the 90, because the gamma is always highest where we have the strikes of these levels, I'm getting gamma long again. Gamma long in this case means excellent. I'm losing long positions and I'm even getting short. And when the market keeps falling, I'll start making money again. Why is that so interesting? Oh yeah, first of all, this market mechanics. Gamma, Vanna, and Charm. There are 3 videos on the channel with this, which go in English into the details and might give you a leg up to understand what's really happening in these markets when we are going through the time, when we're approaching OPEX, and what happens when volatility goes up or goes down. Why is this? Now it's the final time that I'm going, before I'm going into the books. Why is this so interesting? There is one large position out there in the market. Allegedly, and I'm using allegedly liberally because I haven't seen it anymore. I'm out of the trading floors for a while now. There's a huge position by JP Morgan from one of their funds, which is invested in a huge bunch of equities, huge volume. And that pretty much assembles where I started with the S&P. So what are they doing? They're doing exactly this thing every 3 months. The market knows it. The market knows roughly the levels where they are. There are some special bells and whistles in there. But if you then know they're doing it roughly every time when we have a quarter over and then the new trade comes in, you already know in the market, where did they start putting up this hedge? Where were their 105 and where were their 95 and where were their 90s? Then you can identify the position where we are now. And then you have an idea what transactions market makers will have to do, because they are the ones who are hedging their positions. Will they provide liquidity to the market, or will they extract liquidity from the market. And then the client puts on the new trade at the new levels, has exactly what he or she wants in this setup, and the market maker goes on with his or her daily business of hedging transactions. And if you want to know a little bit more about this, Option Volatility in Pricing, Quantitative Finance is a great book, and Dynamic Hedging as well, which go a little bit more into these details for you to understand the dynamics that are involved. Or, as I did show you a second ago, you simply go through my videos Gamma Flip and Gamma Prison, Vanna Rally and Vanna Crash, and why charm matters, and you get a rough idea why we are talking about these hedges. And hey, when push comes to shove, you have a position with your private investments and you think the market is in really weird territory right now at the moment, that's what you're going to do. You put on a cheap hedge. Yeah, it takes some pain on the downside out. You can actually put the variation in yourself. You can do the calculations on the screen, and you don't have to worry too much about what's going to happen. If you don't do that, if you're just an equity investor, yeah, what's left? Usually, most of the equity investors start buying puts when volatility is trading at 35 and the market has already taken a dump of 15-20%. So you can save you this agony by following simple principles which institutional fund managers are doing well, since options are being traded and they can take advantage of these profiles. Then I thank you very much for your attention. If you like this presentation, it's in English. Yeah, I want to serve the English-speaking market as well. Like it, share it, give me a comment, especially on my English videos. Not a lot of people, as much as the Germans, are watching it, but I really like the comments. People seem to like that, and that's why I've decided I'll bring more English-speaking content for our international viewers. And at the beginning, I always have to slip in the risk disclaimer. Nothing, absolute nothing of what I showed you today shall be construed or be investment advice. It is like you buy a course, you go to university, somebody tells you how things work, you sit with your favorite trader over lunch and he explains you how the mechanics of the market work, what's the structures. That's how it's intended, to give you a leg up, to give you a little bit of institutional know-how in the market, to direct you or point you in the direction where you can find this stuff in books. And it's really nothing to do with me giving investment advice, how you structure your portfolio. I hope you enjoyed that. And I hope I'll see you soon on this channel with, well, obviously, let's see how this video goes, and I'll decide then whether we talk more about market mechanics and various positions and trades that are out there in the market to give you a leg up, or we go into something completely different. It was a pleasure being with you today. See you soon. Bye-bye.